I'm joined now by Robert McAdie. Did I pronounce that right?
Correct, yes.
Who's a global head of credit research and strategy at BNP Paribas. Robert talked earlier today, and he's going to give us a few of the highlights of his talk. So, Robert, you mentioned that the quest for yields has been leading to a tightening of the spreads and potentially an underestimation of the risk premium right now. Mm-hmm. Could you elaborate on that point and on how you think this will unfold in the near future?
Well, with the artificial stimulus behind the government bond buying programs, i.e. via QE2, has obviously lowered broad level risk premium significantly, where with yields sub 3%, investors are obviously very hungry to get further return, and that's fueled this ongoing carry trade where the search for yield has dominated the purchase of high yield corporate bonds in particular. It's also dominated the purchase of subordinated bank securities, as investors really are looking for income. And that focus on income has obviously been a key factor. Concern I have going forward in an environment if growth doesn't pick up more aggressively with rising input inflation prices, you're going to start to see margin erosion for some of the weaker, more cyclical companies, and furthermore deterioration of bank balance sheets. So I expect to see a greater dispersion in risk premium as we go forward.
So is this an argument for QE3?
Not necessarily. All I'm saying is that I think
carry you over until things pick up.
I think what has occurred is a very, very strong skewing of all risky asset classes to more common beta, and I think as a result of that, your dispersion or distribution in pricing has been skewed too narrowly, and I think that has to start to change going forward. So in a way, what I'm saying is a more healthy distribution in the pricing of risk going forward.
Okay, good. Then another topic you touched upon is looking forward. You identified two broad roadblocks, I would call them. Mm-hmm. So on the one hand, the commodity prices and all the issues with the developing nations, and then the European problems. Can you elaborate on those two?
Well, I've pointed on the fact of margin erosion for domestic cyclicals due to higher commodity prices. Mm-hmm. The other key factor, obviously, is food. And we've seen pretty rampant food inflation. In Asia right now, you're looking at food inflation of the order of 16%. And the net impact particularly on emerging market countries where the basic wealth transfer has been very limited, and a lot of people are kind of on the borderline or the bread line. Any major market increase in food prices has a disproportionately large impact on their living standards and ability to survive. So as such, the likes of what we saw in North Africa, in my view, will only just continue, particularly obviously with the El Nino effect and some squeezing food prices, but also you've got a structural supply-demand issue where you had a large amount of the population have moved from the agricultural sector into the tertiary sector, and that's structural, mainly in China and India. But also you have rising fuel prices, obviously fueling, again, sort of implicitly the cost of food. So that to me is a big issue, particularly for the emerging market countries.
And what about the impact on commodity producing nations? I mean, in the short run they're benefiting from it, but
the commodity producing nations have benefited obviously from the demand for core commodities from Asia. Mm-hmm. But where the tail comes back and stings you is that if your workers start to strike and start to rise up against you, your ability to have such large margins goes down. You will have to raise wages, and furthermore it could result in pretty acrimonious disputes which will lead to outages, and we've seen what the outages have been like due to the Fukushima effective meltdown, and outages in terms of overall supply of components for the auto sector, and that's had a real marked impact.
So that's basically a question of equity within producing nations.
Correct. So I would be more bearish on emerging market equities. In fact, I'd see a shift, and we have seen a shift earlier on when those actions were happening towards developed market equities.
And Europe?
In Europe, clearly the ongoing issue is the sovereign crisis relating to Greece now, Ireland, Portugal, potentially Spain, potentially Italy. That is going to be an ongoing issue. I think the big problem there is that to be able to do these fiscal adjustments and be able to effectively restructure the overall existing debt is going to result in pain. I think it's inevitable that there will be some form of restructuring, reprofiling. I think in the current program, it's looking at getting some sort of private sector contribution to the latest rounds of discussions around Greece. I think inevitably Greece cannot survive with the budget deficit that is going at the moment. The other subtle point, however, is in these fiscal consolidation programs, it's going to mean it's going to be very, very constrained for growth. And that means you're going to have rising levels of consumer loan defaults, rising levels of commercial real estate defaults, rising levels of also residential housing defaults. So I am concerned around the credit quality of a lot of the European bank portfolios as we go forward. And interestingly enough, one country which has not been focused that much on because it's not part of the peripherals is the UK, where in the UK at the moment we have a kind of a pseudo-stagflationary type environment, and the economy is massively levered to the short end of the curve. So any rising in inflation is going to mean a pretty aggressive rising in rates, and I think quite clearly that is the Achilles heel around the success of the UK economy pulling through after the crisis.
Then just a weird question maybe. Likelihood of Greece leaving the euro?
I think politically that is an unpalatable event. Why do I say that? You know, the vested interest at stake here in the whole creation of the European Union and the euro do not want to see the whole part of the euro and the European Union collapse. Now, if it was only a crisis relating purely to Greece, I think the broader impact would be very limited, because Greece's impact in terms of GDP for Europe is about 3%. The issue is not Greece. The issue is Ireland, Spain, Portugal, and there's other countries. So if Greece happens to go, it's going to cause a massive ripple effect to those countries. And the contagion issue is what they're trying to avoid. That is the key problem, actually.
And I mean, as a Greek, I always thought it was maybe a mistake for Greece to join the euro so early. What's your feeling on that? Was it rushed? Should they have? I mean,
look, in my view, you cannot have a monetary union if you don't have a fiscal union, and that is the core to this problem. So effectively what you have when you have monetary union without fiscal union, it's like a country which is a bit like one of these emerging market countries that have a pegged exchange rate, and they have no ability to manage their overall two parts of the whole economy, monetary and fiscal. At the moment they can only do the fiscal. Fiscal's not done properly. With effectively you've got a pegged exchange rate, everything falls over.
Great. Well, thank you very much.
Pleasure.
And very interesting discussion.
Thank you.